Welcome back to Vantage. It's a very timely fund manager interview that we've got this time. There's been a lot of noise in the market about private equity coming in and looking at a cheap UK market. We've got someone who's on the show who's got a background in private equity, but he manages public equities now at an up-and-coming asset manager. Let's go take a look. Welcome back to Vantage. Delighted to have a manager from Gresham House here join us today, Ken Wotton. Welcome to Vantage. It's your first time. Welcome to the show.
Thank you.
Ken, first time on to Vantage. Perhaps we could just start with a little bit of your own sort of career journey in terms of what brought you to Gresham and the team you run today.
Okay, yeah, so a very brief potted history. I graduated from university, came to London, worked briefly in a call centre, which might surprise you, and selling telecom services to small businesses. After a year, I then went to KPMG, did chartered accountancy there, then moved into equity research. So I worked for a big bank, German bank called Commerzbank, covering large cap pan-European telecoms companies, and then I moved to a small broker in London called Evolution Securities, doing telecoms technology research and fundraisings, and sort of found small companies a bit more dynamic. And then 2007, I moved from sell side equity research into fund management at Living Bridge, which is a UK mid-market private equity firm. Spent 12 years there, and then my part of the business from Living Bridge was acquired by Gresham at the end of 2018, and so the team and myself and funds came across, and sort of 4 and a bit years in, we're still going strong. Okay,
and give us what you described as managing the public equity team effectively. Give us an overview of what that encompasses, some of the funds that you run, and roughly the AUM that you're sort of controlling.
Sure. So within the context of Gresham House is roughly £8 billion worth of assets under management. My team run about 1.1, and that's across a few different funds, but broadly we run the Baronsmead Venture Capital Trusts, which are a combination of public and private companies. So my team manage the public component of that, but they're typically very small listed companies on AIM. We then have a microcap fund, a smaller companies fund, and a multi-cap income fund, which are all open-ended vehicles. So microcap invests below 250 million, smaller companies between 250 and about $1 billion, and then the multi-cap income, it goes right across the market cap spectrum from micro through to the FTSE 100. And then we also have an investment trust, Strategic Equity Capital, which is a very concentrated portfolio of small cap companies where we take big stakes and actively engage with the management team, and that's really a sort of pure play of the strategy that we have when investing in small companies.
We'll come on to the strategy. I mean, I'm interested in the mix of funds, and when you meet young companies and like what they're doing, does this sort of structure allow you to follow them through their life cycle? Because often we come across sort of small cap fund managers who like a company, but it's just got too big for them.
Yeah, absolutely. So as long as it continues to meet the criteria for one of our funds, I mean, it's a great way of continuing to back businesses, and we sort of talk about having the fund structures to be able to back a business right across its life cycle. So the ideal case study would be something that was invested in by our private colleagues in the VCT funds, listed on AIM as a really small business, and then sort of graduated through all the funds and ended up in the FTSE 100. I don't currently have a case study of one getting all the way yet to the FTSE 100, but we certainly have a number of case studies of businesses that have come from being very small, and then we've continued to back them with the other funds as they've grown and become more mature. So a good example of that would be a business called Inspired, which is an energy consultancy business. It advises corporates on how to optimize their procurement of energy, but also how to optimize their consumption. So you're getting cost-saving advantage, but also it's very ESG and sort of sustainability-focused agenda as well. That business I first backed in an IPO through our VCT funds, Baronsmead, in 2011, and the company was tiny then. It was 11 million market cap when it floated. I think it made about £1 million worth of profit. We've continued to back that business through multiple fundraisings when it's done acquisitions. As the business matured and grew, it started to pay a dividend. So it's we've invested in our microcap fund, and then latterly we invested in our multi-cap income fund, and it's got attractive dividend yield, generates really good cash flow, and importantly, the dividend is growing, and we can. I hope that one day I can tell you that it's made it to the FTSE 100, but it's a little bit away from that.
Yeah, no, it's good, and we'll touch on the idea of following finances later. What's the investment philosophy that you sort of impart to the team? What are you looking to do in terms of the companies you're trying to find that are going to be good investments?
We describe our investment strategy as taking a private equity approach to public markets. So, and hopefully we understand what that means, because we spent 12 years working in a private equity firm running public company portfolios. And what we mean by that is really trying to focus on the business itself first. So focus on business fundamentals and trying to find high quality companies that are doing something different, that have a competitive advantage, that can grow over the life of our investment. Ideally, if we find them when they're small, we can not only do we make money out of the companies growing their profits and cash flows over time, but we also make money because they get re-rated as more people sort of understand and find out about them. Yeah. So we like businesses in areas with structural growth behind them, high quality fundamentals, so strong profit margins, a competitive advantage we think is durable and sustainable. High conversion of profits into cash, strong balance sheets, and then really, really importantly, and this is more sort of subjective judgment, is quality of management team. So we want to really back high quality people, good boards with good governance, with good skill sets around the chief executive or who's running the business, and importantly, alignment of interest with us. So we don't want to invest in businesses where we think the CEO is got a different agenda. We want someone who's really fully bought in, both emotionally and financially, to what we believe we're trying to achieve together.
Yeah, there's hints of Warren Buffett in there, particularly the idea of one of the things that stands out for Warren Buffett is that you got to think about would you own this business in its entirety, and your statement of this private equity approach it sort of tunes into that, the alignment between owner and shareholder.
Yeah, kind of ownership mentality. We take our stewardship responsibilities really seriously. When I think about what I do, I don't. I might look at a Bloomberg screen, but I'm not investing in share prices that go green or red on Bloomberg every day and thinking about it in a short-term way. I'm investing in a business for 5+ years that I think can really grow, and then I'm thinking about how to value that based on what whole businesses will transact for. So the other benefit of private equity mindset and our network in that area is we have pretty good insight into what private equity are buying and selling when they buy and sell whole companies. And so we can benchmark the valuation of the businesses we're investing in that are listed, not just against the peer group of other listed companies, not just against their own history in terms of their share price, but also against transactions that have happened in the private markets as well. And that gives us really, particularly at the moment, it gives us really high confidence on the valuations that we're paying.
Yeah. So, a part of what you've articulated is you're looking for structural growth. Let's get a little bit more flesh on this in terms of maybe walk us through some of the structural growth themes that you're finding exciting, you're looking to play.
Yeah, and there are a number of them. And we're typically looking for businesses that are not overly cyclical. So we avoid sectors like oil and gas, mining, real estate, and banks, that kind of thing, and particularly where there's big external factors like commodity prices, which can be the main driver of your returns. So we're trying to find businesses that are less cyclically exposed. And then when you talk about structural growth, within sectors there are certain thematics where we think there's reasons to believe there's going to be a tailwind to growth for the next few years. So an example of that, it's a huge theme, and it won't be controversial to talk about it, but is digital transformation. So every business across every sector is investing in technology to some degree to make their customer experience better, to win customers more effectively, to serve them better, to make their business processes more efficient, to deal with regulation. There are all sorts of different reasons why companies might sort of invest in tech. And whilst we do invest in technology companies that are selling into businesses, we're also investing in companies that are enablers of other people doing that. So a good example is Alpha Financial Markets Consulting, which is a consultancy firm focused on the financial services sector, particularly asset management. And they are helping their customers who are who are blue chip asset management firms globally to implement technology solutions, either to combat sort of fee compression, to help them to organise when they consolidate, when businesses are bought and sold, and there's acquisitions, to implement systems to help them manage the regulatory sort of process, which, as we all know, is only going one way. There's more regulation, and so that business, even though the markets in which their customers are operating in have been quite volatile over the last 2 or 3 years. Actually, their business has been remarkably strong. In fact, they've been growing really strongly, accelerating, and actually having forecast upgrades, because their customers, even if the markets are good or bad, they still need to invest in technology to do what they're doing.
Okay. Now, as I've been reading about your approach to things, one of the things that stands out is that you like the idea of there's a team of people that you can bounce ideas. So tell us a little bit more about the team, the diversity of skill sets they bring to help you make your investment decisions.
So we believe strongly that a collaborative, team-based decision-making approach is the best one. So rather than just being having a staff fund manager and then everyone else kind of goes and does the spreadsheets or the research, we believe that we've got a bright group of people in our close team, and if I can't convince my colleague, who I've gone through an extensive recruitment process to hire someone I think is really sort of talented, if I can't convince them that we should invest in something, then I'm doing something wrong. Either I've missed something or I've not articulated it properly. So there's 5 of us in our direct public equity team: myself, Brendan Golston, who are sort of named co-managers on various of the funds. But then we've got 3 colleagues. There's a financial due diligence background. There's a corporate broking background. There's myself as a sort of analyst background and accountancy background. Got someone who is an M&A investment banker. So, all financial services careers, but different perspectives and so people are just bringing a slightly different perspective on companies and how they've interacted with them over their careers. And then we also have, and this is a really important differentiator for Gresham, is we have a private equity business within the same division. So there's 5 of us doing public equity, but we also have, I think it's now 21 people doing private equity as well, investing in the same sectors. And we try to interact as much as possible with those people, because they've got a different skill set, different perspectives. They sit on the boards of private companies. So you're just trying to all the time tap into the expertise, the knowledge, the experience of the people that can help you to make better decisions. And
you have an investment committee as well, but particularly for strategic equity capital. I'm aware of that. How does that interact with? So the team comes up with an idea, does its work, etc. You take that to investment committee.
It depends on the funds, but so for the investment trust, above a certain threshold in terms of the size of investment, we will go to the investment committee, who are a group of very experienced individuals, both internal and third parties, or non-executive members, both with industrial and investment backgrounds. And what that's really designed to do is, firstly, tap into that knowledge and experience to help you kind of direct the due diligence we're going to do, or ask challenging questions about the investment proposal, but also to add an additional layer of scrutiny and risk management to the process. So the investment trust SEC that we run, it's very concentrated. It's typically around 20 holdings, of which the majority of the value is in 10. So you've got to make sure you get those ones right, and therefore having an extra layer of scrutiny over that is right and proper. In the open-ended funds, where we've got 40 to 50 holdings, investment committee don't have to sort of sign off on an individual decision. They just scrutinise the portfolio management and performance and risk management as a whole.
Okay. The due diligence process, I think, is really interesting, and I think sounds like you're bringing non-conventional sources of information effectively to help your process. So I just wanted to get a little bit of colour in terms of how that works. So for argument's sake, examples where you see a business and you get a sense of actually what are the right margins that this business might make, either from the private equity team or from your network. How does that work, the due diligence process?
Yeah, so I think what's really critical for us is to be really clear as a team about the critical judgments that we're making, which, if we're right, means that the investment will be successful, and also the key risk factors that could blow that off course. And so if we're really clear about identifying the 3 or 4 things that really matter for this investment, and then the right questions to ask to help build conviction that we're correct, then the second component is finding people within our network, which is not sell-side analysts and people who maybe have a vested interest in a particular bias, but people who are operators or practitioners in a particular sector or situational experts, and we can find people who have the expertise and knowledge that's relevant to the question we're asking, and we can identify the right question. Then we can build our own conviction in our investment case by effectively validating with independent sort of experts to help us to sort of build our knowledge and to confirm our views. So it's a bit different to what other people are doing. Our network's been built up over sort of 16 years now, and whilst we're in a private equity environment and sort of enhanced significantly since we've been at Gresham, and it's all about not these are not a bank of people who we speak to every day, but we have people who are very close in our network, or investment committee members, etc., who then they have their own personal networks, and you get a goodwill, you have goodwill reciprocation, and they introduce you to someone who they know, who's pre-qualified because they've worked with them, whose judgment they trust, and then we can go and ask them the question, and they can help us to fathom out what we're looking for. So, or challenge it, and we don't talk about it as much as we do about the investments we do make, but just as important as the investments we don't make, because we've kind of found out something which challenges our view. Yeah, I think that's really important. It's that you don't. It's the ones that you don't make that you don't necessarily. And it's also continuing to challenge the view. So you might invest in a company. You're not done then. Yeah. If we're investing in it for 5 years, then you need to continually reevaluate and make sure that if circumstances change, or you have to make sure your conviction is still valid. I mean, you read a lot of headlines, and we'll touch on a couple. One of them is this sort of continual outflow out of UK equities, but your team has seen inflows coming in. Is it the fact that you're doing things in a very different way that you attribute to that? Well, I think in order to attract people to invest in your funds, you've got to have good performance. Mm-hmm. You've got to have good longer-term performance to prove that it's not a fluke. Yeah. We think consistency of performance is very important. So it's one of the reasons we don't do some of the sectors that we avoid, the commodities, etc., is because they are inherently more volatile sectors, so your returns are more volatile. So I think having good returns and delivering consistency so your investors understand what to expect, being good at communicating what they should expect in different market environments, mm-hmm. And then, so not surprising them, and then doing something which is differentiated, doing it in a different way to everybody else, which where there's a clear process and you stick to it. I think that's what really matters. So if something goes wrong, investors will forgive you if you've articulated your process, you've stuck to it, and then something's happened, it was unforeseen. They won't forgive you if something goes wrong and you've done something completely different to what you promised that you would do. Yeah, now it's very timely that you're here, because we schedule these things months in advance. But last couple of weeks, you've seen a lot of headlines about the value of the UK market, the continued interest of private equity. And I thought you're a perfect person to ask about that, given the private equity background and the fact that you're working in public markets. So what do you make about the UK value and the fact that you have seen over the last couple of weeks, bids coming in? Yeah. So if you ask probably any UK equity manager, they will tell you the UK is looking very cheap relative to other developed markets, particularly the US. Yeah. It's at multi-decade low points in terms of relative valuation, and there's lots of reasons why that might be the case, but that's what everyone will say. I think the second point is that it's not universally the case across the whole market. So there's some things are really, really cheap, and other things they might look cheaper than they looked 2 years ago, but they still don't, to my mind anyway, don't necessarily look that cheap. So you have to be quite discerning and selective. To your point about the private equity, I think there are a number of pockets of really quite exciting value opportunities in the UK market, particularly in small mid-cap area, because you've seen outflows from UK funds, and because the UK has just been out of favour. So everything is sort of derated, regardless of the quality. So if you're prepared to actually look properly at the companies and find the ones which are higher quality, and they've been derated in the same way as something which is less high quality, then that to me is a really exciting opportunity. And because we're focusing on high quality businesses with long-term opportunities, all the things we talked about already, those are the same things that private equity are looking for, and corporate buyers as well. So if they can see high quality companies trading at valuations which are much lower than private markets, much lower than overseas companies that are similar, then that's an opportunity for them. So it's not surprising that private equity are coming and having a look at the UK small cap, mid cap market at the moment. We've been saying for a while we expected it to, there to be a resurgence in takeover activity because valuations are just too low. Being an optimist, I hope that a few takeover approaches for UK public companies will start to shine a bit more of a light on the fact that there is a real value opportunity, and then money will start to come back into the sector, and we'll see a general re-rating. Because we obviously don't want all our companies to be taken over, but I think it's not necessarily a bad thing as a catalyst to show people that there really is interesting value.
Yeah, and I think that point you made about your the idea that you like companies which you can back over the long term, and you express the follow-on capital of we support their growth, they support their acquisitions. It's been interesting that when you look at the burst of IPOs that took place in the post sort of pandemic, performance generally has not been great across that cohort, and so is your sense that once you found a company, you're more inclined to continue backing the companies that than go completely afresh? I mean, it's a real challenge, I think, for the IPO market.
I mean, I maybe slightly different to some of my peers, but we've always been very active in the IPO market. We think, and it's partly because we've got a really well developed private market network that often when a company comes to the market, we can reference the people, we can find out about the track record of that business when it was private through our private equity contacts. So. And it may be that some of our colleagues have met that business in the past and interacted with it in sort of quite a sort of deep way. So we can really get some insight, which perhaps our public market only colleagues might not be able to do. So we can feel comfortable with the diligence that we do on an IPO, whereas some people will say they want to see the company deliver for 2 or 3 years as a public company before they're prepared to look at it. You're right. There were companies that came to the market in 2021, and performance has not been good for a lot of that cohort. But you have to remember that's also coincided with a huge derating in the market and a big shift from growth to value. And a lot of the businesses that floated in 2021 were sort of exciting growth businesses, and it doesn't mean they're bad businesses now. It just means maybe they floated at a too high a price. And actually, there's been some really interesting opportunities resulting from the fallout from those businesses kind of getting derated. So, and a great example, Moonpig, that floated in 2021. It floated at a high multiple. We didn't invest in it at the IPO because we felt it was too expensive. But I think it's a really good business, and the whole of the e-commerce sector has been battered by the market. It's all been derated really, really significantly because of all sorts of issues with supply chains and e-commerce and sort of cost of acquisition for online companies, consumer demand because of the cost of living crisis, lots of factors which have rightly sort of impacted those companies. But Moonpig, the quality of the business model is just significantly better than more transactional. You buy someone a birthday card every year. You probably buy multiple people birthday cards every year. They're brilliant at reminding you about that. Brilliant at selling you additional gifts alongside the card. Gross margins are really high. It's the market leader. There's still a transition from offline to online in that space. It's a great company, and now you can buy it at what looks to me like a bargain price. So
that's a good example. And maybe so, if I to bring all of this together, maybe you can just walk us through one or maybe 2 examples that gives you here's the things we're looking for in terms of the structural growth theme, something that you might have been invested in a long period of time, so you got to know it reasonably well. You like the direction it's going in.
So on the latter, so there's a company called Netcall, which is a software business, software as a service, cloud-based, and it's software to help corporates and government organisations deal with consumers and customers. So it's customer engagement software, so relating to call centres and web chat, quite topical in the world of e-commerce and online transactions. And it's also got software which helps businesses that join that up with business process automation in the back end of to automate transactions. I first invested in the company in 2010. We put money into back an acquisition, and it was a one-product company at that point, and it was all on-premise software. And the business has developed really significantly over the years. We've continued to back it. We've backed acquisitions, so when they've raised money, and we've also bought shares in the market. And we're now clearly the largest shareholder in the company. And it's going from strength to strength, and they're just won the biggest contract in their history with a large global insurance company, really evidencing that they can sell not just in the UK but globally, and they can sell multi-million-dollar contracts, not just sort of smaller contracts that they I guess may have been a perception, and the share price is sort of close to all-time highs. So that's a really good example of a business that we've been patient backers of. We think that the team are high quality, positions high quality, that the product's good. That's really playing out in the operational performance of the company and then therefore the share price.
That's a really good example, and I think weaves a lot of what we talk together together. The final thing, I guess, is that a lot of people watch these to educate themselves about the investment process, particularly our audience. I think they like to understand how to go around sort of picking the right investments. If I was new to your team, what would you given the experience that you had, what are the sort of the golden rules of thumb, the bit of advice you'd give, or some recommended reading that you'd suggest?
Look, I think in terms of rules of thumb, just try to understand how you as an individual think about investing. What interests you? What is how do you think about deconstructing a potential investment opportunity? And so obviously I can give advice as to how I do things and how I think about things, but everyone's different and every fund manager is different. And the most important thing is to be quite self-aware about how you think about things and what what drives you, and then come up with a process that's systematic and stick to it, but also don't be afraid to innovate and iterate it over time. But just do what you think to do. Stick with your own principles. So that would be my main bit of advice. And in terms of books that I would advise people to read, I've things like Ben Graham's Intelligent Investor. Those things they're kind of staple reading for people. But the book that I read in the relatively recent past, which I just think it's got interesting lessons, is the Big Short by Michael Lewis, and it's a pretty mainstream book. There's a film made about it, and it's very easy to consume for non-financial people, so you can understand what's going on. But the thing that I learned from it is just it's about people being prepared to stand up for their principles, to do their own work, to understand something themselves, and then be prepared to go against the crowd and be contrarian if you really believe that you've done the work and it makes sense and it stacks up. Don't be wobbled by sentiment. Be focused on the fundamentals that you've sort of worked out yourself, and that's kind of how we operate. So I'm not scared to do something contrarian. I'm not scared to go with the crowd if it's the right thing to do, but you just do the work yourself.
It's a great book. I read it in 2 days over a holiday. I always remember that. Ken, that is great. Thank you very much for coming on to Vantage. Okay. We look forward to seeing how the year develops for you, and hope you can come back onto the show.
Okay, thanks for having me.